Welcome to Breaking News to Trading Moves. I was looking at this analysis recently, and imagine perfectly timing the market every single day for 24 years.
Wait, like buying the exact bottom and selling the precise top?
Yeah, exactly. Buying the exact bottom, selling the exact top. The odds of you hitting that perfect sequence by chance are, well, 2 to the negative 99th power.
2 to the negative 99th? I mean, that is essentially zero. It is functionally impossible.
Right. It is basically zero. Yet researchers took that historically optimal timing sequence and they ran it through the National Institute of Standards and Technology statistical test for pure randomness.
Oh, wow. And what did they find?
The result was that the mathematically perfect sequence of trades was completely indistinguishable from random noise. Meaning, even if you achieved it, your success contains zero predictive information for the future.
So we are debating the tension between systematic, rules-based investment strategies and discretionary, active trading.
Exactly. The core question is, can human judgment and adaptability consistently beat the market, or is active trading just a statistical illusion that inevitably transfers wealth to disciplined, rules-based systems?
And I approach this from a completely different angle. The math might show randomness in aggregate, but aggregate statistics entirely ignore the reality of outlier skill. Top-tier discretionary trading transcends random chance by synthesizing technical indicators, economic drivers, and, market tone.
Well, I will be arguing that systematic, factor-based, and passive approaches governed by strict rules are the only mathematically sound methods for market participation.
And I will defend the necessity and superiority of discretionary, active trading when executed by highly skilled market participants.
So let us look closely at that Vanguard fund analysis spanning 24 years of total stock, total bond, and balanced indices. When a researcher maps out the optimal timing path to maximize returns, and the statistical test proves that path is structurally identical to a random walk, the implication is pretty devastating for active traders.
Devastating how?
It proves mathematically that trying to predict the next market move is futile. And this perspective is backed by exhaustive empirical data from the Taiwanese stock market from 1995 to 1999. The data reveals a stark wealth transfer mechanism. Retail traders lose heavily when they place aggressive orders.
Wait, by aggressive, you mean market orders where they demand immediate execution?
Precisely. They cross the bid-ask spread because they want into or out of a stock right this second. They demand liquidity. On the other side, institutional players systematically absorb that aggressive order flow using passive limit orders.
Right, sitting on the bid.
Yes, the institution sits back, waits for the retail trader to cross the spread, and mathematically captures the difference over thousands of transactions. The active trader is operating on a gut feeling, while the institution is operating a mathematical system.
I am sorry, but I just do not buy that this applies to top-tier professionals. You are describing the average impatient retail trader.
But the math.
Relying solely on that cohort ignores the mechanics of variant perception. We see this exact scale in the historical records of exceptional traders like Michael Marcus and Bruce Kovner. Consider Marcus's legendary plywood trade in the 1970s.
Okay, plywood.
Yeah. At the time, the price of plywood was legally frozen by the government at a ceiling of $110 per 1,000 square feet.
Well, the mechanical system would look at that legal ceiling and treat it as absolute, unbreakable resistance.
Exactly. An algorithm would sell the moment the price hit $110, assuming it could not possibly go higher. But one day, Marcus noticed the futures price trading 20 cents over that legal limit.
Oh, really? Over the legal cap?
Yeah.
A rigid system would flag that as a data error or immediately short it. Marcus, using human discretion, recognized the context. He realized the futures market was functioning as a supply of last resort. Buyers were so desperate for wood, they were willing to pay a premium over the legal limit.
So he bought into a capped market.
He did. He anticipated the formation of a black market and bought. The price eventually drove to $200. That is variant perception, the ability to understand the context behind a price anomaly. You cannot program that into a passive system.
I hear you on Marcus, and the plywood trade is a very compelling anecdote. But look at the psychological data. Human psychology, which drives that so-called variant perception, is mechanically a liability that destroys capital.
Yes. We can look at the decision tree psychological risk assessment data from currency trading to see how this plays out in reality.
You are talking about the models that analyze trader behavior and loss patterns?
Yes, exactly. The models show that historical losses do not distribute evenly across the day. They cluster in specific trading sessions, like the Asian or London sessions. Why? Because of human fatigue and emotional strain. An algorithm does not get tired at 2 in the morning.
True. Computers do not need sleep.
Right. Furthermore, the decision tree data reveals how human traders get constantly distracted by irrelevant metrics. The researchers introduced a parameter called hypothetical balances into the model.
What are hypothetical balances exactly?
It represents the what-if scenarios playing out in a trader's head. Like, if I hold this trade, my account will hit this milestone. Or, if I close now, I avoid dropping below my initial balance.
Ah, the mental accounting that distracts from the actual chart.
Exactly. When those hypothetical balances were introduced, they emerged as the root node of the decision tree, meaning they became the primary splitting point the algorithm used to determine outcomes. It needlessly increased the depth of the tree and severely degraded trading performance. A rules-based algorithm never feels the anxiety of a losing streak, nor does it get distracted by hypothetical milestones. It just executes the mathematical expectancy of the system without hesitation.
That makes sense in theory, but mastering psychology, rather than trying to completely remove it, creates the ultimate trading edge. The physical and emotional context of the market provides data that a computer simply cannot parse.
Data like what?
Well, Marcus explicitly noted that when he was on the trading floor, he used the intensity of voices in the ring as a primary gauge of market momentum.
But relying on the volume of voices in a room is incredibly subjective. How does that not lead directly to emotional trading?
Because professional human discipline is maintained through strict, uncompromising rules. You do not just listen to the yelling and buy blindly. Marcus implemented a mandate regarding extreme momentum.
What kind of mandate?
He knew commodities could go crazy, so he had a rule: if a commodity hit its absolute maximum permitted daily price increase, a limit up day, he would begin exercising extreme caution by the third consecutive day, and he strictly forced himself to exit the position entirely on the fourth or fifth consecutive limit up day.
Just completely exit?
Yes, he recognized the momentum was no longer based on fundamentals, but pure panic. He used his discretion to step aside.
Which ironically sounds like a very systematic rule to me.
It is a rule to govern his discretion, which is vastly different from surrendering all decisions to an automated system. Similarly, Bruce Kovner had a strict rule to place a technical stop loss before even entering a trade. His position size was dictated entirely by a pre-planned technical barrier, not his emotions. They managed their psychology. They did not eliminate it.
Fair enough. But if a discretionary trader is stepping aside when momentum gets extreme, as Marcus did, who is left capturing the mathematical edge?
The automated systems, presumably.
Exactly. That brings us to factor investing. Any genuine measurable market anomaly should be captured systematically. If human behavior consistently creates inefficiencies, a quantitative framework can exploit them far more effectively than a human manually placing trades. We can look at the SEI factor investing framework,
Which attempts to categorize behavioral quirks into mathematical formulas, right?
Precisely. Systems can automatically exploit structural market inefficiencies based on those exact behavioral foundations. Take the value factor. It systematically captures mean reversion caused by investor overreaction and loss aversion. Humans panic, sell a stock below its intrinsic value, and the value factor mechanically buys it. The momentum factor captures trends driven by investor underreaction and anchoring to past prices. A factor model is like a casino's business model. It does not care if a specific player wins or loses a hand on a Tuesday. It mathematically captures the edge over 10,000 hands.
So discretionary traders are just players at the table?
Discretionary trading is trying to be the card counter at the table. Why would an investor rely on a manager's subjective reading of market tone when a factor composite can mathematically target those exact behavioral mispricings across a globally diversified portfolio of 300 to 600 stocks?
Because the casino model assumes the rules of the game never change. Mechanical systems are entirely blind to macroeconomic context and regime alterations. A factor model assumes the future distribution of returns will resemble the past. Kovner warned explicitly about the dangers of this rigid assumption.
How so? I mean, the math of loss aversion does not change just because the decade changes.
The human emotion might not change, but the economic environment definitely does. Kovner noted that in periods of stable, moderate inflation, simple technical trend-following systems will merely kill each other off.
Because there are no trends to follow?
Exactly. They will generate endless false signals because the macroeconomic environment simply does not support sustained multi-month trends. The systems just whip back and forth, grinding down capital.
But a multi-factor system adapts to that by weighting different factors.
It still requires past data to adjust those weights. True market outperformance requires the ability to read what the chart is not saying in real time. Kovner observed that a tight price consolidation breaking out without obvious news in the Wall Street Journal indicates a much stronger underlying cause.
Wait, hold on. Why would a breakout with no news be stronger? Usually you want a catalyst to drive price action.
If a market breaks out because of a known headline, the move is often unsustainable retail hype. Everyone reads the paper, everyone buys, and the move exhausts itself. But if a market breaks out and no one knows why, if it is completely quiet in the press, that means the institutional accumulation is real.
Ah, the smart money.
Right. Smart money is quietly positioning themselves for something big. A factor model simply sees price movement. It cannot differentiate between a breakout driven by retail noise and a breakout driven by quiet, informed institutional buying. It completely lacks the context of the news cycle.
That argument hinges on the idea that human intuition can reliably spot institutional footprints. But let us look at the reality of where trading profits actually originate. This leads directly to information asymmetry. If you were listening to this and thinking, well, I made money day trading last year based on my intuition, the Taiwanese market data explains exactly what happened.
Oh, you're going back to the liquidity provision argument.
Yes, because the data tracking 25 and 140-day periods shows that when individuals attempt to actively time the market over those horizons, their initial profits completely erode.
And why is that?
Because the institutions on the other side of those active trades possess actual, non-public information about the future prospects of the underlying companies. The active retail trader is operating under the illusion of skill. They might win a few trades, but over a 140-day horizon, the institutional algorithms and passive systems capture the spread and the long-term risk premium.
So it is just an information imbalance.
Exactly. The math demonstrates that trying to out-discretion the market is a losing proposition over a long enough timeline because you are always trading against superior information.
I completely acknowledge that the average retail trader loses capital. The data on that is indisputable. But experts operate in a completely different paradigm when it comes to processing information asymmetry. Let us look at a historical example of superior information processing from Marcus. In late 1978, Marcus and his team were holding massive short positions on the US dollar.
Based on the macroeconomic trend at the time, which favored a weaker dollar.
Right, exactly. But suddenly, the market got mysteriously strong. There was an intense price movement upward that could not be explained by any known public information or technical factor model. Relying on their discretion and market feel, Marcus and his team bailed out of their short positions immediately.
They just closed out?
They took the loss and stepped aside entirely.
And what happened?
That exact weekend, President Carter announced a major dollar support program. The currency skyrocketed. If they had stayed short, they would have been wiped out. The top discretionary traders read the footprints of central banks and governments in the price action before the news broke.
Wow.
An algorithmic factor model waiting for moving averages to cross or value metrics to realign would have been caught entirely off guard by that sudden political intervention. Discretionary traders make intuitive leaps based on geopolitical context that rigid models completely miss.
Well, that is a very compelling anecdote. But to summarize my position, while a rare handful of traders like Marcus might possess an innate, almost unquantifiable gift for reading market tone, the empirical data strongly favors a different reality for capital allocation.
Which goes back to the probabilities.
Yes, the Vanguard optimal timing analysis proves that trying to predict market sequences is mathematically indistinguishable from randomness. The Taiwanese liquidity data proves that active intervention mostly just enriches the passive systems on the other side of the trade. The optimal path relies on patience, global diversification, and systematic factor exposure to mechanically balance risk and return without the interference of human emotion.
And to summarize my stance, while passive and factor strategies certainly provide a solid baseline for capital preservation, they leave vital returns on the table by ignoring macroeconomic context. Rigid systems are incredibly vulnerable to regime changes.
Fair point.
I maintain that a disciplined, discretionary approach, one where a trader operates with strict rules, risking no more than 5% on a single idea, and cutting losses at pre-planned technical levels, remains the most robust way to navigate complex, politically driven markets. You need a human at the wheel when the environment changes unexpectedly.
We do find clear convergence on the absolute necessity of risk management. Whether it is enforced by a quantitative algorithm executing a volatility target, or a human like Kovner strictly adhering to a pre-planned stop-loss rule, cutting losses is vital to survival in any market environment.
Absolutely. Evaluating the balance between active and passive frameworks requires ongoing study of the material, leaving the listener to determine which philosophy aligns best with their own understanding of market mechanics.
Because ultimately, whether you choose to trust the unrelenting probability and mechanics of a casino or the highly attuned situational awareness of a professional card counter, well, it depends entirely on whether you believe human skill can consistently beat the house edge.